Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Paul Moore. Mr. Paul Moore has done a lot of business in real estate, from flipping houses to rental properties to residential and commercial development, and he's even appeared on HGTV's House Hunters. He's the author of a great book called The Perfect Investment, and he's the co-host of a very popular podcast called How to Lose Money. Paul Moore, welcome to the show.
Hey, great to be here, Juan. Thank you so much.
Yeah, thank you so much for making it here with us today. So, let's kind of get into the show and tell us a little bit about, where are you calling us from, first of all, and tell us a little bit about your background. Fill us in on that.
Well, I actually got an engineering degree in the 80s. That was my first mistake. I didn't know who I was. I wanted to be a parapsychologist. I wanted to be a Ghostbuster when I was a kid. And that I realized when I was in high school, they didn't have a degree in that. So go figure. But I got an engineering degree, and then I went on and got an MBA, fortunately, at the Ohio State University. I went to Ford Motor Company, and within a couple months of being at Ford, I realized that even though I liked Ford, I was bored. And so I started looking for side ventures. I started looking at maybe starting an oil change shop or a commercial property tax consulting business. Had a bunch of ideas, but finally about 5 years later, I ended up leaving Ford and started an HR outsourcing firm. And Wall Street got real excited about that whole business model. And in about 5 years later, I was a finalist for Entrepreneur of the Year in Michigan twice.
Nice.
And then Wall Street got excited, and a publicly traded firm bought our firm for a fairly outrageous amount of money. And so I moved to the Blue Ridge Mountains of Virginia, and I was starting a nonprofit organization to actually connect with international college students studying in the U.S. Got pretty bored pretty quickly because nobody else was as aggressive as I was. I was in my mid-30s, type A. And so started flipping real estate, and that's how my last 18 years have gone, is from flipping to real estate development, did a subdivision, did a multifamily from ground up, helped with a Hyatt hotel, flipped about 36 high-end waterfront lots at Smith Mountain Lake in Virginia, written a couple books on real estate. It's just been a fun ride.
Wow. That's so much, such a big background that you have, and so much experience that you've done. And, from like we said, from flipping houses to development to so many different things. So let's kind of talk about, what your focus is, here been lately. What have you been focusing on here lately?
Well, so the Hyatt hotel did not go so well. And so I was thinking about what I wanted to do next. This was about 5 years ago, and we'd already operated and sold a multifamily kind of quasi hotel in North Dakota. And so I thought, well, we should get into buying existing multifamily. And so I found a mentor, spent a year with the mentor, then spent another year trying to write a book. I had researched it so much. I had enough information for a dozen or two special reports, and I just turned it into a book, build a website. But what I didn't do, Juan, is I didn't start raising money. I kept thinking, well, money will come, get the right deal, the money will follow. Well, I found out that wasn't true. And so finally started raising money. And then by then the market was already overheated. It got so overheated that we have just, all of the partners are in our 50s. We decided we didn't want to lose money, contrary to the name of my podcast. And we decided to be super conservative on our underwriting, which we still are. And we are very, very careful. But we're buying multifamily assets. We closed on one in Lexington, Kentucky. It's a 125-unit townhome community just several months ago. And we're looking for our next deal.
Awesome. So you mentioned earlier that you did not raise, you didn't even think about raising capital. What was the reason for that?
I think it was fear. I think it was pixie dust. I really believed that maybe it would just fall from the sky if I had the right deal. I had one very large potential investor in China, and I kept thinking, well, we bring the right deal, he'll bring all the money we need. And I brought him 2 deals, and both did not work for him. And so I think it was fear. I really think that I had heard that it was the hardest thing to do in business, the highest paid skill, the most important skill. We've all heard that. And I just didn't know if I could do it. And what I found is when I started, through a lot of study, a lot of prayer, a lot of trying to figure things out, I realized I can do this. And actually, I think it's my number one skill now, just a few years later.
Okay, so you're saying it's because of fear. So how did you overcome that fear? Just by doing it, or what was that?
I'm going through my journals, my old personal and business journals from a couple of years ago, and I'm able to recapture what I was thinking then. And I think I live in a small town. Like I said, we moved to the mountains and we've raised 4 children here. We've never left this rural area. And I didn't think I knew where to meet investors. And so I thought, where am I going to find, dozens and dozens of investors who, with money, they're not here. So I just didn't know what to do. And I actually listened to an amazing podcast called The Family Office Club. I actually completely stumbled into this podcast. My wife was in a store. I just flipped on it randomly. And I went on this show, and I think it was providential because the guy was talking about being a bear at a waterfall. Have you ever heard that analogy, Juan?
No, I have not. No.
It's amazing. He said, if you're way up north and you need to survive, you can learn to spearfish in a dark lake. And that means, you'd have to get really good. You'd have to know how to aim the spear. You'd have to know how the water, potentially bent the angle of the spear that you threw. You have to wait and stand by the dark water for hours or days on end, waiting for a big fish and, throw it and hope to hit the fish. He said the other way to do it would be to be a grizzly bear. Stand in the waterfall, open your mouth real wide, and wait for salmon to jump into your mouth. And when I heard that, I realized, wait a minute, that's what we need to do. And the guy was just saying, that's the way to run a business. That's the way to raise money. That's the way to live. And I thought, well, how can we do that? And so I thought about it, journaled about it, sought some advice, prayed, and figured out how to be the bear at the waterfall. And that's made all the difference.
Great. Yeah, that's a great analogy. That's something that we should definitely put into action and put into use. And I really like that. So thank you so much for sharing that. Let's kind of let's talk about the markets that you look into whenever you're looking for multifamily properties. You mentioned Kentucky, right? Lexington, Kentucky. What was special about that market, and why did you proceed in that market?
Warren Buffett said you should always build a moat around any property or any business or any company you buy. And he's done a great job of that, obviously. Building a moat, of course, is raising economic barriers to entry for competitors. And so, of course, in the old days, in medieval times, a moat was a water barrier around a castle. Well, there's attackers for castles, and there's also attackers called competitors for businesses. Lexington, Kentucky has done a great job inadvertently erecting a moat around the city. They have a $2 billion tourist industry, and a lot of it's based on horse farms, which are very close to the city. So they've constructed what they call an economic barrier, and it's a urban services boundary. And that means they're not going to run water, sewer, or approve any commercial projects outside of this very limited ring. Okay. And so there's all kinds of horse farms really close to downtown. I mean, just, maybe a 10-minute drive from the center of the city, and they want to keep it that way. And they've done it for decades. What this means is it's very limited on new apartments as the city continues to grow, and it's grown every year since the Civil War. The city has continued to grow while the apartment building, there's very little room. If somebody mentioned if someone came in here with $50 million to build apartments, they wouldn't have any land to build on. So it's a great moat. That's what we like about Lexington.
Yeah. So it's a higher barrier to entry, and that's what makes it really attractive, right? So, and you mentioned, earlier that, we talked about private money and raising capital. Are you syndicating these properties whenever you actually go to acquire them?
Yes, we are. Mm-hmm.
Okay. And how are you structuring these deals?
So on that deal, we gave investors 80% and we get 20% after the investors get an 8% pref. So they get an 8% preferred return. Anything above that, they get 80% and we as a syndicator get 20%. Now, of course, we have some asset management fees to keep the lights on along the way as well.
And what would you say the asset management fee is on average?
It would be about, it's actually floating and we don't get paid the asset management fee unless the investors are getting their pref. So to the percentage of the pref paid in that year is the same percentage of asset management fee that we are able to earn. And it would typically be $40,000 or $50,000 per year.
Got it. That makes sense. Okay. And so I want to talk about any kind of upgrades that you're doing to these properties. I mean, is there a certain type of property that you're looking for? I know a lot of us, we tend to look for value add potential on these properties. So is there a certain type of upgrades that you need to do, and what kind of rent premium are getting on those upgrades?
Yeah, so this property unfortunately had just been upgraded internally. So it had new appliances, new countertops, completely new cabinets, new flooring, but it had kind of dingy carpet on the stairs and all through the upstairs. These are all 2-story townhomes. And we just wondered, based on the year build, which was the early 60s, there was the floor, these were very quiet. And, a lot of apartments are loud. And we thought, I wonder if there are hardwood floors under these carpets. And there were. And so there were beautiful hardwood floors.
Yes.
And so, for about a $1,300 investment per unit, we're able to take the carpet out, refinish these beautiful floors. And for an additional $50 is what we're getting in rent. So if you do the math on that, that's $600 a year on a $1,300 investment. That's about a 45% return on investment. And so that's one upgrade we're doing. Another thing we did that was really important is they had a water bill, which was about $118,000 a year. And that looked really high. And so we checked with a consultant and found out it was probably 110% higher than it should have been. So it should have only been about just under 50% of that cost. So we installed water meters. By doing that, we saved $12,000 a year on our Freddie Mac green loan because we saved 2.2% or 20 basis points on the loan. And Juan, we're finding toilets running every day that are costing thousands of dollars of water per day, per unit in some cases. And they're random. Like one might be running in this unit and we go fix that. Another one might run in another unit. We go fix that. And so this is a huge savings because we're paying for the water. And even if the tenant was paying for it, we want to save water. And so we were glad to do that. We're also putting in programmable thermostats that'll allow the tenant to better manage their heat as well.
Got it. So what was the cost on these thermostats that you mentioned, and also the water conservation, like to individually meter these units?
Yeah, it was about $68,000 for the water and sewer meter, the water meters, and about another $10,000 or so to add the thermostats because there was one router that operated both the water meter and the thermostat. So honestly, adding the thermostats was very inexpensive after we already had the water meters.
Yeah, that makes a lot of sense. You're able to, for a relatively small amount, you're able to do a lot of cost savings, right? First of all, at the property level, and even like you mentioned, if the tenant was paying for it, they would also be, in the savings. But at the end, you're able to increase the value so much, because, you increase your NOI and, we all know how that works. So I really like that, that you were able to define the value there on that specific property. So
yeah,
we talked about this earlier before the podcast, how, right now the market is kind of heated. We're actually seeing it, pretty overheated in some cases. So what are you doing to maintain discipline in such a hot market that we're in like today?
All the partners in my company, Wellings Capital, have lost money. We've made money, of course, on many things, but we've lost money on things. And we had to look investors and our family and ourselves in the eyes and realize, that was really painful. Well, we're all in our 50s. None of us want to lose money again. And so the reminder of that pain has helped us maintain discipline, continue to conservatively underwrite, and continue to say no far, far more than we say yes.
Okay, awesome. But what exactly are you doing when you're underwriting these properties? Can you give me more specific, details on that?
Yeah. So, I mean, we're not underwriting an overly aggressive cap rate when we sell. We're not.
So what is your cap rate? So let's say you're buying at a 6.5 cap rate. What is your exit cap rate?
So our goal would be to put at least a percentage higher. So if we're buying, let's say we're buying a value add that has a lot of immediate upside at 5.5, but we can get it up to 6.5 real quick. We'd want to be underwriting that to a 7.5% sale, for example.
Yes. I think that's one great way to be conservative, because hey, you know what, it might actually happen, and if you underwrite it to those numbers and it happens at that cap rate, then hey, you knew it going in, and if it stays pretty heated whenever you're going to exit, then that's just a little extra icing on the cake, right?
Right.
Awesome. Was there a deal that you passed up that you felt that it came across your desk and you passed it up, but now that you look back on it and you're happy that you did pass it up?
Oh, there's hundreds of those.
Okay.
I mean, anything with a high crime score. Look, Warren Buffett said it's better to buy a great company at a fair price than to buy a fair company at a great price. Well, Juan, translating that to real estate, I'd say this: it's better to buy a great property in a great location at a fair price than it is to buy a fair property in a mediocre location at a great price. And so over the years, every time I did not follow that advice, I didn't hear it till later. Thanks, Warren. But at any rate, anytime I didn't follow it, I paid dearly for it. And I bought a lot of mediocre properties in mediocre locations. Thankfully, those were flip houses typically, and we were okay. But not following that advice, I should say, has helped us maintain the discipline that we have.
Got it. I want to flip the script a little bit on you. You obviously have a great podcast called How to Lose Money. Okay. So I want to flip the script, like I said, and I want to ask you how you lost money on a specific deal.
My goodness, where do I start? So love him or hate him, 30 years ago, I got to be honest, I'd never heard of him, but there was a guy, I was in grad school getting my MBA. It was 1987. And I read an article about a younger, at least, Donald Trump. And Trump said the most important rule for real estate is never fall in love. Now, Juan, I'm all about love. I've been married for 31 years. But it's really easy to fall in love with a property and begin to justify all the reasons it's the right thing and to ignore all the negatives about it. Hey, my wife did this with me when we were dating, but that's another story.
That's a whole nother story.
Yeah. But at any rate, I used to love Cape Cod homes, the Cape Cod style with the windows upstairs and the, half finished upstairs and all that. So we were flipping houses. We had just flipped 2 or 3, so we were experts now. It was 2001.
Yeah.
And we saw a Cape Cod house that was in pre-foreclosure. So we went and visited with the owners. We negotiated a deal. And we ignored that it was in a declining part of town, right? I thought, who wouldn't love this beauty?
Right.
Well, falling in love with that beauty cost me thousands of dollars, months of heartburn, and I realized, again, what had been said before: don't fall in love with a property.
Yes, 100% accurate. And we all talk about, don't fall in love with the property, fall in love with the numbers, right? If the numbers make sense, and then you can proceed. Fall in love with the numbers, not the property. Take emotion out of it, because it's so easy to get all emotional with the property. I feel like it's going to do this. I feel like it's going to do that, and I see the projections. Well, you got to make sure that they're pretty accurate, and do your due diligence as much as you can. So that's a great advice. Before the podcast, we kind of chatted a little bit, and you mentioned that you're actually focusing a little bit differently these days, and actually it's not multifamily. You're kind of steering a little bit different direction. Can you talk about what it is that you're doing now?
Juan, you can't ask somebody who wrote a book called The Perfect Investment about apartments how he's investing in something different.
Hey,
You really want to put me on
the
the
title
spot?
doesn't say multifamily though. It just says the perfect investment.
Look
So,
at the subtitle. The subtitle
oh,
is
does it? Okay, okay,
Enduring
awesome.
Well from the Historic Shift to Multifamily Housing.
There
So
you go. The key word is
with,
multifamily at the very end. Yeah.
if you're going to put me on the spot, I'll do it. One, I'm frankly, I have 220, 230 investors. And as soon as we closed on our most recent deal, within a month or two, they said, what's next? They liked the process. They like what we did. And we didn't have anything. And we've looked at about 160 deals since January. As I'm talking right now, it's early May 2018. And we've gotten a little frustrated. So somebody came along that I met on Bigger Pockets, and they started talking to me about self-storage. Now, I had no interest in that, but I had admitted in my book and at other times on podcasts that self-storage probably had as good or better than apartments in risk-adjusted returns. And so I didn't really think much about it, but then I started researching a little bit. Now, think about this one. If you have $1,000 apartment in Houston and you get a 6% rent increase, that's $60. You might consider leaving. But if you have a $100 storage unit and a month-to-month rent, and you think, I'm going to go out there and pare down on a Saturday pretty soon, I'll get rid of that storage unit in a few months. If you get a 6% rent increase, that's $6. Are you really going to pack up a U-Haul, get a friend, waste half a day or a whole day packing up all that stuff to haul it down the street to save $6?
Yeah,
Probably
it's
not.
not going to happen. And
Yeah,
then not to mention where you're going to take it to. Yeah, you can
right,
go take it out, but where you're going to take it to another storage unit or your
yeah,
house where it's going to be, cluttered in your garage. So yeah, that
right.
makes sense. Okay.
Yeah, so there's a limit to that thinking. Obviously, you can't just raise the rent at willy-nilly. But here's the amazing thing. There are more storage unit facilities than all the Starbucks, Subways, and McDonald's combined. Okay, there's 53,000 facilities in the US. 40,000 or so are run by independent operators and a lot of mom and pops. So the rents may be low or the occupancy may be low. They might be making, a profit. Here's what I've learned. It's really easy to run a mediocre self-storage facility, but it's really hard to run a great one. And so what I did is I did a little research, and I actually stumbled into, and then I've now visited in person with a self-storage company twice who is doing it great. The returns are amazing. They're scooping up a lot of these smaller mom and pop owned facilities. I mean, the average facility in the U.S. is 52,000 square feet. They're getting them, average 50 to 100,000 square feet each. And they're able to dramatically increase the income. And I'm talking about like doubling it over a couple of years.
Nice.
And then they're, by doing that, they're able to refinance or sell and give the investors an amazing return. And they're just doing it over and over again. So I'm actually investing with them. We've got a handful of investors who are doing a trial run with them this coming month. So I'm pretty excited about what we're finding. Didn't ever plan to do anything outside of multifamily, but I'm going to try this for a little bit and see what happens.
Hey, that's part of being an entrepreneur, right? You have to kind of, give other things a try as well. And, it doesn't mean that you won't go back to multifamily. It just means that, hey, maybe things are a little overheated right now. And so, I want to, keep moving. So let's try storage units. And so the other thing I like about storage units is that one thing that you didn't mention it's pretty obvious, but we didn't mention it, is that you don't have to deal with toilets. You don't have to deal with tenants that are living on the property, necessarily. So you're not going to get calls in the middle of the night. Well, if you're a smaller landlord, right, you're not going to get calls in the middle of the night that, hey, this is not working, that's not working. So, it's pretty much just a box, and you go in there and you throw things in there, and then, what was going to happen to the box, it's metal, so, and not to mention, there's opportunity, so, there's opportunity in finding, a mom and pop run storage facilities and go in there and implement a good business plan, and run it like a business, and then you can take it to the next level, right? So,
right, that's absolutely true. And the tenant laws are much easier. Evictions are much easier than there are with real people in apartments,
Yeah, and so if you guys are out there and, we all know that it's pretty heated, then, that might be an opportunity for you guys to kind of search in your area and see what you can do as well. But always remember to do your homework and find the right guys that have experience like he did. He found some great guys that already had really good experience and was able to kind of work with them. And so don't go in there, just blinded as well. So, So thank you so much for that. So I want to ask you, what do you attribute your success to up to now? What is your success attributed to?
That's a really hard question. I mean, I've got a lot of factors, I would say. A type A personality. I was, adopted as a kid and felt like a kind of an underachiever, I guess. And I always felt like striving for more. So I work really hard. I really like my work. And I really feel like God's hand is with me to do it well. And I think that's really important to me, to be ethical and to just hold to this high standard. I think one of the things too is just admitting weaknesses. I have a small group of folks that meet in my home once a week, and I am the first to admit if I'm struggling, first to admit if I'm down. Hey, I've got a podcast called How to Lose Money, right?
Yeah.
So I think just that humility to tell the truth is kind of refreshing in a world where people are trying to always, tell how great they are. I find that there's another side, because everybody knows in their heart that they fail sometimes and that they're weak sometimes. And I think being able to admit it is helpful.
Yes. I love that. That's a great answer. Just be humble about it and be honest and be truthful, because, no one's perfect really. So, and if you say you're perfect, then you're lying to yourself, so,
right.
I want to ask you also, what do you do to get back, Paul? What do you do? What's your mission? What's your drive there?
Yeah. So Juan, you're right there in Houston, and you probably know of the horrors of human trafficking, but maybe some of your audience doesn't. Did you know if you took the record, I said the record year profits of Apple, Nike, Starbucks, and General Motors combined, doubled that number, that's the approximate annual revenue from human trafficking.
Wow. You said all those combined and then you double it still?
The record profits of all those combined times 2. Okay? Wow. It's a serious issue. And Juan, I like to believe that if I was alive in the 1830s or 40s, I would be fighting slavery. And I'd like to believe that if I was an adult in the 1960s, that I would have been against, bigotry, and I'd been fighting for civil rights. We've got a similar problem here on our hands. These people are being enslaved. There's 21 million people being enslaved, and the horrors of what's done to them is unspeakable. Let's put it this way: some of these pimps are making $250,000 to $500,000 per year per girl.
Oh my God. Yeah, that's an insane amount. Yeah. I mean, first of all, it shouldn't be happening. And it's just ridiculous. Like, for us to even think about, how much these guys are making. And, it just, we need to find a way to be able to limit, because it's going to be hard to kind of stop it, but we need to find a way to limit it.
Right.
I know one thing that we do through my church, Community of Faith, it's a good church that I attend and I volunteer every week, is, they do a lot of international mission trips, and the domestic trips, or the domestic opportunities that they do is for the human trafficking and sex trafficking that we have here in Houston. It's such a major problem, and it's just guys like you that can contribute to that cause. I think that goes a long way, and it's able to help us out. So
so what we're doing is we are trying. My business partner, Dr. Brian Robbins, has adopted 7 Russian orphans, and he adopted them all the same day. And so he's passionate about giving back to help sponsor orphans. I'm passionate about thwarting human trafficking and rescuing its victims. Just a second. This is a film called Nefarious. And this film is, I recommend your audience gets it. In fact, if they want to email me, I'll send you a free copy of this film, Nefarious. It's put out by Exodus Cry out of Kansas City. You can go to exoduscry.com. But I'm trying to do everything I can to promote awareness and to help people realize the importance of fighting against this and rescuing these poor victims. So Wellings Capital is trying to plow a significant amount of our profits into fighting human trafficking.
Oh, well, thank you so much for that. Thank you so much for allowing my audience to have the opportunity and for everything that you do to that cause, so, it's greatly appreciated. And thank you so much. I want to personally thank you for that.
You bet.
Awesome. So, Paul, I want to get into our nuggets of wealth, real quick. And so these are questions that I ask every week to every guest. And hopefully, then they can help the audience, in one way or another. So I want to ask you, what key tip or advice would you give to those who are wanting to take their business to the next level?
Well, I think there's 5 ways to get into multifamily. I'm trying to write a book called The 7 Paths to Multifamily Millions. 7 sounded better than 5. And so, but seriously, one is to, I know a guy in Dallas who did this, to build your portfolio slowly. Get a duplex, fix it up, rent it out, sell it. Use the proceeds to buy a 4-plex, rent it up, sell it. Go up to a 12-plex, rent it out, sell it. And of course you can keep these, but it's a lot faster to sell them. Well, when I met this guy, he was 22 years into this cycle in Dallas, and he was selling an $11 million apartment complex with 131 units. And he was going up to almost a 200 unit. And so that's one way to get into multifamily. A second way is to be a deal finder for another multifamily company. Get a piece of the action. A third way is to be a capital development specialist, go on board with them, raise money for their deals. A fourth way is to, what is the fourth way? Well, there's got to be a fourth way. A fourth way is to actually be mentored by a multifamily mentor. And all over the place, there are great mentors who charge a price. But that's what I did. When I decided in my 50s that I wanted to get into multifamily, I decided I want to be mentored. I want to get on a fast track. And that helped me so much. There are some great mentors out there. And then a fifth way is actually to invest passively in a deal, but ask the syndicator if you can look over their shoulder during the whole process and learn the business. And so those are 5 ways to get into multifamily. The key for me, what I would tell the audience would be pick one of those ways and jump on it full-heartedly. And don't try to do all 5. I mean, you can try to do 1 or 2, but stay very focused. A friend of mine just ran for the governor of Colorado. He just dropped out. I talked to him for an hour this morning, and he said that he's been rubbing shoulders with billionaires. And he said the thing that they do better than the rest of us is they get one thing they're laser focused on, and they do that really well for decades. And so that's what I'd recommend.
Great. I mean, you gave us a bunch of tips there. So guys, if you have to listen to the podcast again and definitely listen to what he had to say on those different tips. So, you pick one of those, like you said, and just run with it, and become, great at that one specific area. So awesome. What is a good tool, source, or platform that you use frequently that can also help others?
Yeah. So Hubspot has a free version, and we have managed all of our investors and almost all of our contacts in HubSpot.com. It's actually quite expensive to upgrade, but we haven't found the need to do that. I know a lot of people spend hundreds or even $1,000 a month, but it's worth it. It's a great tool.
Yes, plus one on that, because I also use HubSpot, and obviously, I use the free version, but I think the free version is way more than enough, unless you want to. I don't know what the paid version is for, really, because the free one is enough. So right. Definitely, guys, check that out, HubSpot.com. What book are you currently reading today?
Well, I'm rereading a book called The One Thing by Gary Keller and Jay Papasan. And I read it 2 years ago, and I said, this book changed my life. It didn't change my life at all because I didn't implement it. it takes 66 days on average to implement a habit. And I didn't put any more than a few days into it. And I didn't really know what I was doing. So recently, I had Jeff Woods on my podcast. He's the host of the One Thing podcast. And I was so impressed that I started listening to his podcast. I joined the One Thing mentoring group. It's only $30 a month, and I highly recommend it. So there you go.
Awesome, man. You're giving us a bunch of little nuggets over here, so I appreciate that. I want to ask you one last question. At the end of your life, how do you want to be remembered?
All right. Pharaoh, if you go back 4,000 years in world history, Pharaoh had a title, but Moses had a testimony. And I want to be remembered with a testimony. I want to be remembered as somebody who cared about people, somebody who worked hard. And, if I had to work a 12-hour day, fine. But I care about people along the way. I actually have a stash of $2 bills I give out to kids and people at restaurants. And I just want to be remembered as somebody who's kind, who's loving, who loves God first, loves people second. And that's how I want to be remembered.
I couldn't have said it better, man. I love that answer. Love God first, and love people second. Thank you so much. That was awesome. Where can Come Into Wealth Nation go to find out more about you and Wellings Capital?
All right. You can go to our website. It's wellingscapital.com. That's WELLINGS capital.com. You can go to our podcast, How to Lose Money. And if you want to schedule a time to talk with me, I'd love to do that. You can do that through our website.
Awesome. Well, Paul, thank you so much for your time. Thank you so much for all the wealth and knowledge that you gave us and you share with my audience. I greatly appreciate that, and I wish you continued success.
Thanks, Juan. This has been great, and I love your show, and I really love what you're doing, and so I really appreciate what you're doing for your guests, and look forward to staying in touch. And hey, I don't know if you've ever lost money, but if so, we'd love to have you on our show.
I hope that, not to lose money, but it's one of those things. That's where we learn from, right? You gotta, sometimes it's unfortunate, but it's also where you learn the most, right? So, and to add to that, he just mentioned his podcast. Guys, definitely check out his podcast. It's great, and he talks about how to lose money, but it's about the mistakes that people make, in their journeys as entrepreneurs. So that is truly, truly where you learn the most. And so his podcast is great. Definitely check it out. And I'm a frequent listener of that podcast as well. So I'm recommending it. So check it out. So thank you so much, Paul, once again. And I appreciate it, and have a great rest of your day.
Thanks, Juan. You too.
All right. Thank you very much.